Let's discuss the married put to speculate in stock markets. This is when an investor buys a put option for an equivalent number of shares they own in the underlying stock. It's a way of ensuring the value of the investor's holdings. What is the primary objective of the married put strategy in stock options trading? The objective of using a butterfly spread in stock options trading is profiting from minimal price movement in the underlying asset. This strategy involves combining both bull and bear spreads with the same expiration date, using either calls or puts to capitalize on a stock that is expected to have little to no significant price change. The primary goal of a married put strategy is to hedge or insure an investor's stock holdings against potential declines in value. By purchasing a put option for an equivalent number of shares they own, the investor secures the right to sell their stock at a predetermined price, thus limiting potential losses if the stock price falls. This strategy is focused on risk management and capital preservation, rather than on income generation or speculation. How does the married put strategy perform under different market conditions? The butterfly spread strategy is ideal in low volatility, stable markets. It performs best when the underlying asset's price remains close to the middle strike price of the spread. In contrast, in highly volatile or significantly trending markets, the effectiveness of the butterfly spread decreases. Married puts are particularly effective in uncertain or bearish market conditions where the risk of a decline in stock value is high. This strategy provides a safety net, allowing investors to retain their stock positions while being protected from significant downside risks. It may be less necessary in bullish markets where the likelihood of a stock price drop is lower. What risk is associated with the married put strategy? The risks involved in a butterfly spread strategy are limited and defined. The maximum loss is restricted to the net cost of entering the trade, which is the cost of buying the spreads. This limited risk makes the butterfly spread an attractive strategy for traders seeking to control potential losses. The risk in a married put strategy is limited to the cost of the put option premium. If the stock price does not fall below the strike price of the put, the investor will incur the cost of the option without any offsetting benefit. However, the potential loss on the stock holding itself is capped at the put option's strike price, effectively limiting the downside risk. What potential rewards can be expected from a married put? The rewards from a butterfly spread include capped gains within a specific price range. The maximum profit occurs if the underlying asset's price is exactly at the middle strike price at expiration. The profit potential is the difference between the strike prices minus the net cost of entering the trade. The primary benefit of a married put is the protection it offers against significant losses, while still allowing for capital appreciation if the stock price increases. The best case scenario is the stock price rising, rendering the put option unnecessary, with the investor benefiting from the stock's appreciation. However, the cost of the put option will reduce the overall profit. What are the key implementation steps for a married put strategy in stock options trading? Key steps in implementing a butterfly spread include selecting the appropriate strike prices and expiration date for the options involved, ensuring the middle strike is aligned with the expected price of the underlying asset at expiration, and monitoring the market to manage the position effectively. The trader needs to carefully plan entry and exit strategies to maximize the potential of the trade. Implementing a married put strategy involves owning or purchasing a stock that the investor wishes to protect, buying a put option with a strike price at or slightly below the current stock price. The expiration date of the put should align with the period during which protection is desired. Paying the premium required for the put option, which is the cost of the protection. Monitoring the stock and the put option, particularly as the expiration date approaches or if market conditions change significantly. Deciding whether to exercise the put option if the stock price falls below the strike price, or to let it expire if the stock price remains stable or increases. A married put strategy in stock investing offers investors a way to protect their stock investments against significant declines while maintaining the potential for upside gains. It requires balancing the cost of the put option against the value of downside protection, making it a prudent strategy for risk-averse investors or in times of market uncertainty.